Okay, hello everyone, and thank you all very much for joining today, and welcome to our latest global webinar where we aim to give you a quarterly update on the main news stories, headlines and developments in financial markets, with of course a particular focus on how this is impacting the foreign exchange market. Good to see quite a few of you have joined so far. We'll get going and hopefully a few more join in the next few minutes or so. Just by chance, I think this has been very good timing on our part when we were sort of formulating what we'd like to talk to you about today. A few weeks ago, we had, of course, intended to focus on the fallout from the March G3 central bank meetings of the Federal Reserve, European Central Bank and Bank of England, which of course we will talk about slightly later on. But what we have had in the interim, of course, is some very significant developments in the global banking system and global banking sector, triggered, of course, by the collapse of Silicon Valley Bank in the US around about 3 weeks ago. And then, of course, which has triggered some heightened panic around the health of the global banking sector in general. We've seen some major headlines, of course, surrounding Credit Suisse, which we're going to cover, and most recently Deutsche Bank. This has led to some heightened volatility, market panic, and some significant gyrations across financial markets, whether that be in equity markets, fixed income, of course, currencies. So it's been a very busy period for FX strategists such as ourselves, and has given us plenty to talk about in the next sort of 45 minutes or so. So what are we going to cover today? Well, we're going to start off just by giving a sort of a timeline as to what we've seen in the last 2 or 3 weeks or so. Of course, as I mentioned, the uncertainty triggered by the collapse of Silicon Valley Bank, and then the subsequent troubles we've seen after that. We're going to talk about what triggered this collapse of SVB and the general turmoil that has followed, what we've seen in Credit Suisse in the last few weeks, particularly the takeover by UBS that's been brokered by the Swiss government, with a focus, of course, on what kind of impact this has had on financial markets, not just the foreign exchange market, but fixed income and equity as well. We'll then talk about something that's been, or that is of great importance for currencies. That is, of course, the impact that this banking turmoil has had on central bank rate expectations. And they're going to talk about our general view for the global economy and how that feeds into our view that most, or at least some of the major central banks, we think have more room to raise rates, even amid the current market turmoil. And then we'll give our general thoughts on the last couple of weeks of central bank meetings from the Fed, ECB and Bank of England, all of which raised interest rates, but delivered a slightly different tone and stance during their communications. We will have time for questions at the end. So as per usual, as we're going through the presentation, please feel free to drop some questions, any questions that you do have, in the Q&A section in the Zoom app. And we'll get round to answering as many, hopefully all of those questions at the end of the presentation. So without further ado, I think we'll get into the main bulk of the presentation, and we're going to start with a general sort of intro overview as to what we've seen in financial markets in the last 2 or 3 weeks or so. And it has, of course, as I mentioned, been a very hectic, volatile period in markets, which began with the collapse of Silicon Valley Bank. SVB was the 16th largest US bank at the time of its collapse and the second largest to fail in US history. We're going to talk about the more details as to the ins and outs as to why it collapsed in a few slides' time. But ultimately, concerns began when SVB announced a 1.8 billion loss in the value of its securities on the 8th of March. This triggered panic among investors, among depositors, and led to a traditional run on the bank. And within 36 hours, SVB was no more. We saw heightened concerns, again, following the collapse of Signature Bank a few days later, which has sort of gone on under the radar a little bit in the news headlines. The Federal Reserve then unveiled what's known as a bank term funding program, which is effectively a means by which the Fed is providing liquidity through generous loans to US banks. In the days following then, concerns heightened as investors switched their focus away from the US and towards Europe. The next European bank that investors believe would fail was Credit Suisse, which has had a number of issues, a number of bad headlines and scandals and significant losses in recent years. This ultimately led to the UBS agreeing a takeover of Credit Suisse, which was brokered by the Swiss government and facilitated through some significant loans from the Swiss National Bank. And just when we thought the uncertainty and the panic had abated, we saw some more headlines concerning Deutsche Bank late last week. Investors sold off shares of Deutsche Bank en masse. We saw a significant drop in stock price of Deutsche Bank late last week, albeit it has since rebounded, and calm for now appears to have returned somewhat to markets. In the FX market, at least, the euro is now back above the 108 level and just above where it was prior to the drop in Deutsche Bank's share price.
Thank you, Matthew. Sorry, guys, my technical difficulties seem to have been solved, at least for now. So if you don't mind, I can take it over from here.
Absolutely.
Great. So yeah, I think that in order to give a little bit of an overview of the banking problems, I mean, it seems clear that there's some definite issues with U.S. banks, particularly regional ones, which have been subject to much lighter regulation than the large systemically important ones. But the upshot of the market moves of the last 2 to 3 weeks seems to indicate that investors are pretty comfortable that this is not going to degenerate into a crisis, anything like we saw in 2008, 2009. European banks seem to be in much better shape, seem to have not taken the interest rate risk that the regional US banks seem to appear to have taken. Deutsche Bank shares are back to basically unchanged. Banks have bank indexes worldwide have suffered a bit, not massively, but stock markets are back to essentially where they were before Silicon Valley Bank collapsed. So again, the concern seems to have the concerns about systemic or system-wide runs on the banks seem to be fading, and frankly, we think that that's correct. This world bank systems seem to be in much stronger shape. The mutual dependence that we saw in 2008 has been the obsession of regulators for the last 15 years, and they seem to have done a good job of correcting some of the excesses. And in fact, to me, Credit Suisse is the perfect example here, because Credit Suisse is a systemically important global institution, and it was essentially wound down over a weekend, and nothing happened. No creditor outside of the equity-like instruments, no counterparty or depositor lost any money. So I think that markets are correct of taking a sanguine view of the issue. So we go to the next slide. Again, important to remark that even though we had stock market falls in the immediate aftermath of the collapse, these were pretty contained, down at most 4%, and we are back to where the S&P 500 was trading before, with European equity index slightly lower. So stock markets are saying that overall they're not concerned about the crisis. Now, with a market where there's been a very, very sharp reaction is that of interest rates and markets' predictions of where central bank rates are going to be over the next year or two. The effect in the US of this regional banking crisis, even if there's no systemic problems, it will undoubtedly have some impact on the availability of credit for households, and especially small and medium-sized companies, commercial real estate, etc. And it's not clear how much tightening effect it has, but it definitely will have some tightening impact in US financial conditions, which means that the Fed needs to do less to tighten those conditions and needs to hike less than before the Silicon Valley bank collapse. Less clear is the effect of that US-centric problem on other G10 central banks. I think that after Credit Suisse, it's likely that there will be no further banking issues, definitely not in Europe, the UK, or Switzerland, where, again, the problem is affecting regional banks in the US because of the idiosyncrasy of the banking system and the fact that they take a lot of the interest rate risk that the regional banks in the US have to take. European banks pass it on to their clients, such as yourselves, which means that they're not as exposed to higher interest rates. So we think that it is probably much less clear the impact that this crisis will have in interest rates outside of the United States. In FX, as one would expect in a time of when interest rates in the US drop massively, the clear outperformer has been the safe haven, the Japanese yen, followed by sterling, which is a bit unusual. I mean, the US dollar has depreciated against most currencies. EM currencies have performed unusually well in a time of uncertainty, but sterling is one of the best performers because it must be noted that no concerns have been raised anywhere about any UK bank as a result of this crisis, at least so far. We go to the next slide. Again, let's go a little bit into the weeds about what happened at SVB. Silicon Valley Bank is a bank that had grown massively, catering to the tech investor community in California. This startup companies were flush with cash after the pandemic because rates went to zero, and there was an absolute flood of cash looking to invest in these companies. The small companies, the startups, then proceeded to deposit the cash they raised from investors in Silicon Valley Bank. And Silicon Valley Bank used this cash, for which it used to have to pay 0% because rates were at zero, to buy not so much to make a lot of loans, but to just buy a lot of US government bonds and mortgage-backed securities. Now, these are instruments that have no credit risk. There's so far little indication that SVB or regional banks in the US, for that matter, have any significant problems with their credit portfolios, the loans they make to companies and people. But these bonds did have a lot of interest rate risk. They paid very little. They paid, 20 years, 30-year bonds paying 2%. Now rates have gone up to 3.5%, 4.5%. And these bonds have dropped in price, even though they're not expected, nobody is expecting any of these bonds to default. This left a big mark-to-market hole in the balance sheet because, again, that was where Silicon Valley Bank chose to invest this massive expansion in deposits. Investors caught on that essentially Silicon Valley Bank's assets were worth less than its liabilities. And there was a bank run by all these interconnected tech startups that they all talk to each other, all have the same investors, and therefore all pull the plug on the SVB together. Go to the next slide. As a result, there was trepidation about banks everywhere. And even though Credit Suisse did not have any of the issues that SVB had. It had its interest rate. It had not taken this interest rate risk. It was not exposed to an increase in rates. However, it had had other problems for a while. We like to joke that Credit Suisse had found increasingly creative ways to lose money over the last 10 years. And it was in the midst of a very aggressive restructuring that needed market's patience. Another problem that it did have is that most of its depositors were wealthy individuals that were uninsured, whose depositors were above the level which different governments insured, and a lot of them weren't even Swiss. So perhaps rationally, they chose to pull the plug, move their money, and as a result, the Swiss government was forced to intervene. It brokered a takeover by UBS at basically almost nothing was paid to the shareholders of Credit Suisse. And also the Swiss National Bank assisted with a massive loan of $54 billion and another $108 billion in potential guarantees. This is definitely sufficient to calm the markets about any Credit Suisse exposure. And as a result, we have seen small risk of contagion. The big difference between this crisis and the one we saw in 2012 or even 2008 is that, as you can see in the graph, whereas Credit Suisse 5-year credit default swap, an indication of market perception of the solvency of Credit Suisse, while this shot up to levels indicating distress, that of all the other major banks stayed the same or went up, but by much less. So we didn't see this contagion that we saw in previous crises. And that's what equity markets are reacting to, and that's why equity markets are so calm about this crisis. Go to the next slide. Then Deutsche Bank. Deutsche Bank is an interesting case because even though it did have a rough time of it in the years from 2007 to 2015, it's a bank that is widely seen to have effected a successful restructuring. It is profitable. It has solved or written off most of its systemic problems that it used to have. And so it's a little surprising for me to see the CDS prices, credit default swaps, which are again a measure of the market's perceptions of a bank solvency, spiked to 210, which is not distress, but is definitely a significant increase from where it was just a few days ago. The shares dropped on the news, but frankly, this appears to have been entirely due to self-feeding market panic rather than any concern about the balance sheet or the fundamentals. The CDS market is a very illiquid market, so even a relatively small trade can have significant impact on the price, unlike the share prices. It appears, well, the German authorities were quickly on the wire, dismissing any concerns about Deutsche Bank's soundness, and in fact, the shares have rebounded to not far to where they were before this mini panic. We do agree with the stock market assessment that not only is Deutsche Bank a systemically important institution, and there's been no thought of allowing depositors of counterparties to take any loss in any conceivable circumstances, but unlike Credit Suisse, it appears to be a solid bank, profitable, and with a well de-risked balance sheet, and with the full support of both the German authorities and the European Central Bank supervisors. Go to the next slide. Again, it's remarkable how little the stock market seems to have reacted to this news. Equity markets in the US are back to the initial levels. Stock indices in France and Germany have regained about half of their losses as the crisis started. They're still showing, I believe, marginally positive returns for the year. So this just goes to this is further evidence of how massively different the times today are from those in 2008 or even 2012, and how much the strictness and the work of regulators since 2012 on insurance, the soundness of the banking system, how much of a difference it has made in terms of the soundness of the banking system. Go to the next slide. I think I probably will pass this on to Matthew at this point, so he can tell us a little bit more about the biggest outperformance and underperformance the FX market.
Yes, absolutely. Thank you, Enrique. And yeah, we have seen traditional moves in currencies in response to this banking sector uncertainty. As Enrique mentioned, what is generally the case in FX, when we do see bouts of uncertainty, market panic, the safe haven currencies tend to outperform, those being generally the Japanese yen, Swiss franc, US dollar. Chief among those benefited from this particular period of uncertainty has clearly been the Japanese yen in the past month, and indeed since the beginning of the SVB collapse, the yen has by far and away outperformed every other G10 currency. The franc and the dollar have underperformed for various reasons. First of all, of course, the Swiss franc, which performed well right at the beginning of the turmoil, has since lagged behind a little bit, given, of course, focus has shifted away from US banking concerns to Swiss banking concerns, which has partly led to a little bit of an underperformance in the franc relative to the yen. While the dollar itself, as we've mentioned, has sold off against most currencies. As you can see, only 3 G10 currencies have performed worse in the last month. And of the currencies that we cover in emerging markets, at least, the dollar has only performed better than 4 of the main emerging market currencies that we cover. Why is that the case? Well, there's 2 main reasons we think as to why we have seen this dollar underperformance. First of all, of course, investors are concerned about the health of the US banking system following the SVB collapse and the failure of Signature Bank, which has partly weighed on the dollar. Whereas on the other hand, of course, markets have significantly dialed back expectations for Federal Reserve interest rate hikes. Indeed, of all the G10 central banks, markets now expect the Fed to be less aggressive, much less aggressive than any other G10 central bank prior to the current turmoil. So rate expectations have dropped significantly in the US, which we'll talk about in a few slides' time. And on the whole, as Enrique mentioned, that the performance of emerging market currencies is very much a noteworthy one. Generally, during periods of uncertainty, periods of panic, these emerging market currencies tend to sell off. Actually, one of the key characteristics of this current period is that most of them have performed rather well and are actually rallying against the dollar, which perhaps is an indication as to the relatively minimal panic that we have seen in markets. We're going to move on now, and I'm going to pass over to Roman for this little section. We're going to focus on what kind of an impact the banking turmoil has had on interest rate expectations, which, of course, very much important for the foreign exchange market. So over to you, Roman.
Thank you, Matthew, and welcome everyone. So the effect of the recent banking turmoil has been quite significant, as you could see in the equity market, but also we have seen rather sharp moves in the fixed income sphere and in the FX market. One of the biggest effects we have seen is that the market pricing of rate expectations have shifted downwards quite significantly. And on the right-hand side, you can see the shifts in the US Treasury yield, the 2-year yield. So on the shorter end of the yield curve, and the shorter end of the yield curve tends to be reflective of the expectations towards the central bank's actions. So at one point, we saw the drop of the 2-year yield of around 100 basis points in the context of this turmoil, and the one-day drop of the 2-year yield was at one point the biggest since the 1980s. So this kind of tells you about the scale of investors' worries in the context of what happened to the SVB. Also, the FX market reacted to it. Interestingly enough, the US dollar, which is a safe haven currency, so typically when we are seeing some stress in the markets, some enhanced worries, the US dollar tends to outperform. This was not the case this time because the worries primarily concentrated in the US, at least in the first phase of the banking sector fears because of the issues of the SVB and the regional banks. And we saw a decline of the US dollar. The US dollar index has fallen by around 2% since the beginning of the month. But one of the big reasons why the US dollar fell was not only because of the concentration of the issues in the US, at least initially, according to market views, but also because it led to a significant repricing of rate expectations. So the rates were assumed to not grow as much, or actually to be cut rather aggressively. So at one point, the market was pricing in about 100 basis points of Fed cuts before the end of the year. This has corrected a little bit, but still the expected cuts are rather sizable to the tune of about 80 basis points. We think that what happened there has been an overreaction, and although certainly the situation will make central banks, also the Federal Reserve, to perhaps be a little bit more considerate of what's going on in the banking sector and a bit more careful, this likely does not justify the abrupt ending of the rate increase cycle and also a rapid reversal of it. But we think that the Fed will focus on the extent of the credit contraction in the coming weeks, in addition to the macroeconomic data, especially the data on the price growth. Let's move on to the next slide. Thank you. So as you can see on this chart, the decrease in rate expectations in main economies has been very significant. This has been particularly visible in the US and in the Eurozone. However, it has been the case in practically all of the G10 countries, or most of them. I think that Japan has been a little bit of an exception here. We also saw some corrections in the emerging market spectrum. But going back to the G3, the correction has been the most limited in case of the UK. It seems that the United Kingdom is to some extent shielded from those issues, but at the same time, markets' expectations towards further steps of Bank of England have been in the first place rather limited. And also in days when the banking crisis took place and surrounding that, we saw some data from the UK which actually strengthened the opinion of some market participants that the Bank of England will continue hiking rates. And as I think Matthew will say later, they indeed fulfilled those expectations and sounded rather hawkishly. So generally, looking at the rate expectations now, which is the black bar, we see that they have recovered somewhat after the hit from the banking crisis. However, those are still not the levels that we saw prior to all of this commotion. So in general, we think that still what we are looking at are too low expectations of markets. However, it is undoubtedly that the central banks will be a bit more careful, and you can already see it in the central bank's rhetoric after the recent meetings. They clearly are data dependent, but also dependent on the degree of the credit contraction that we are going to see. We think that macroeconomic conditions are warranting further monetary policy tightening. What we are seeing in main economies and effectively across the world, with a very limited number of exceptions, is that the inflation has been more stubborn than expected. It has been sticky. and this warrants keeping the policy tight and raising interest rates, and then not allowing those rates to come down for at least some period of time. We are also seeing economic strength in the macroeconomic data. We are seeing very tight labor market. So those are not the conditions that would warrant an abrupt end of the monetary policy tightening cycle. Those issues that we are referring in this presentation, so the issues of the banking sector, the problems of fears which lead to depositors taking their money from the banks, they need other solutions, and those solutions have been addressed and implemented and are implemented by the central banks. One of it is the Bank Term Funding Program, and this is the new lending program, which will provide a 1 year loans, up to 1 year loans to eligible institution that will provide collateral. So there is even more security in the banking system because of it. We think that a swift reversal in monetary policy tightening would send a wrong signal to the market, that the central banks are perhaps a bit too worried about the situation, and perhaps because of it, the situation in fact is more serious than it seems at this point. So it could cause unnecessary panic in our view. So central banks have generally held firm. They continued tightening policy at the most recent meetings. However, we have seen in many cases some dovish tilts, which in effect stressed that they are going to be even more data dependent, and also take a special look on the situation in the banking sector. Let me pass on to Matthew, I believe.
Yes, thank you very much, Roman. And before we move on to our thoughts on the recent big three central bank meetings, we thought we'd like to give a sort of update overview as to our view on global economic conditions, because of course, central bankers at the moment are facing a very difficult task. On the one hand, they have all this uncertainty, turmoil that's rocked financial markets in the banking sector, whereas on the other, actually, in our view at least, macroeconomic conditions would warrant continued tightening of monetary policy and higher rates. And we're going to talk about that in the next few slides. And in general, data out of the global economy continues to perform rather well, and we're not seeing signs yet of significant downturns or recessions. Recent GDP data is held up rather well. The more timely indicators of business activity, the PMIs, which are one of the main gauges of growth that we look at on a regular basis, these have continued to surprise to the upside and are now back above the level of 50, which separates contraction from expansion. If we look at the graph here, this represents the G10 Economic Surprise Index from Citigroup. Any number above 0, that represents the data is exceeding economists' expectations, whereas a number below 0 represents that the data is largely surprising to the downside relative to expectations. Clearly here you can see what we've seen a trend in the last 6 months or so, whereby now we are seeing more upside surprises than downside surprises in the data. Generally speaking, in the major nations, economic news that we have received in the last few months has been stronger than expected. And markets are now of the opinion that big downturns and recessions, for the most part, will be avoided. Most of the major central banks that we've seen in the last few months, whether that be the Bank of England, European Central Bank, for instance, are upping their growth projections, and in many cases are now no longer calling for recessions. Why do we think that severe downturns will be avoided? Well, for starters, data out of the major economic areas, as I mentioned, has been pretty good, particularly when it comes to the likes of the PMI data. generally showing relatively modest growth, but growth nonetheless, and no signs of severe recessions there. Whereas we've also seen a number of factors and risks to the growth outlook have turned more positive. When we spoke last time, our last global webinar in December, China had just moved away from its zero COVID policy. We expect that to continue to provide support for the global outlook this year. Since then, energy prices have also continued to drop rather sharply. Prices of natural gas, for instance, have continued to decline at a very sharp rate. In Europe, natural gas prices are down around about 80% from their peak last August, which should, we think, filter its way through to weaker headline price pressures and place less of a squeeze on household incomes and disposable spending. Importantly, labour markets remain very strong. This has been a key characteristic that we have talked about for a number of months, and we would have mentioned at our last webinar in December. Again, since then, we're not seeing signs of significant loosening in labour market conditions or a severe deterioration in jobs data. The recent non-farm payrolls reports out of the US, for instance, have been very strong. The last two reports for January and February both surprised significantly to the upside. We've seen nominal wages remain relatively strong, particularly in the likes of the UK, while the ECB in the Eurozone as well is expecting wage growth of around 5 to 6% during the rest of this year, which is very clearly very high levels by historical standards. So that we think should continue to support consumer spending in the coming months. On the other side of things, interest rates appear close to peaking. As we contest, we still think that some of the major central banks still have a little way to go before they pause their hiking cycle. But it is looking likely that we will see an end to central bank rate hikes for many of these major central banks in the next couple of meetings or so, which again should be good news for the growth outlook, while supply chains continue to improve and continue to normalize following the pandemic period, which was particularly challenging for these supply chains. As I said, most major central banks have upped their GDP forecasts in the last few months, and the general consensus is now that recessions are far less likely in the major economic areas this year than anticipated not too long ago. As I mentioned, the PMIs of business activity have moved back above the level of 50. Any number above that 50 mark, that represents expansion in both services and manufacturing sectors relative to the previous month, whereas numbers below 50 represent contraction relative to the previous month. We've seen some solid moves higher in the G3 PMIs in the US, back up to around a level of 53, in the Eurozone 54, and the UK 52, which, while not very significant levels of growth, it is, as I said, growth nonetheless, fueled in large part by sharp increases in service sector activity. Manufacturing has lagged slightly behind, but of course, these major economic areas are far more dependent on service sector growth to fuel their economy. So actually, the composite PMIs, which is a weighted index of both services and manufacturing, are continuing to print at very healthy levels, and nowhere near where we would start to be concerned about the possibility of significant downturns in growth or possible recessions. On inflation, we're seeing a period whereby inflation has started to ease from its highs in most cases, albeit still remains relatively lofty, particularly relative to previous years. And we are yet to see signs in most instances of a sustained downtrend in rates of US inflation, or rates of inflation in general, I should say, which is one of the reasons why we think central bankers central banks still have a little way to go in raising interest rates. In the US, price pressures, at least a headline measure of price pressures appeared to peak in June, and since then we've seen quite a meaningful downtrend in headline prices, albeit the core rate has remained much more sticky, and this is actually ticked up when we account for the 3-month annualized core rate, which was our preferred measure of US inflation. This moved up to 5.2% at the most recent reading from 4.6%. Eurozone inflation, again, the headline rate appears to have peaked, but if we look at the core measure of Eurozone inflation, that has continued to edge up and has shown no signs of abating just yet. Similarly in the UK, again, the core print exceeded expectations at the most recent reading in February, I should say, and actually exceeded expectations by 0.5 percentage points, which is one of the biggest upside surprises we've seen in UK core inflation for some time, and is pretty much unprecedented. The Bank of England has continued to stress its view that inflationary pressures will ease during the rest of the year, but so far we are yet to see that, and as we'll get onto in a few slides' time, that's one of the key reasons behind our call for at least a couple more Bank of England rate hikes in the next couple of meetings. And in general, inflation still remains an issue globally. This is not just something that is troubling the major economic areas, but we're seeing it among emerging market countries as well. It's been very difficult for central banks around the world to bring down rates of inflation in a sustainable manner. And for the most part, it is taking much longer to start seeing that sustained downtrend towards central bank targets, particularly in the likes of Eastern Europe, for instance, where rates of inflation, for the most part, are still in double digits. In the likes of Poland, for instance, it's still at almost 20%. Whereas we're seeing similar instances in other Eastern European countries. An outlier would be some of the countries in Asia where inflationary pressures have been slightly less acute, most notably in China, where inflation is just at 1%. But for the most part, it's been a very challenging period for central bankers. And in our view, the data, at least the inflation data at least, would warrant additional policy tightening, even when taking into account the lag between higher rates and the impact of those higher rates on domestic prices. As we can see here, this is sort of another visual representation as to what I was just mentioning. So this is the Citigroup inflation surprise index for the G10 versus emerging markets. And now, in a similar fashion to the economic surprise index, any number above the level of 0 suggests that the data is surprising more to the upside, whereas the number below suggests that it's missing consensus or falling short of expectations. You can see here that G10 inflation surprise index has clearly fallen quite significantly from its peaks in early last year, but still remains in positive territory, suggesting that we are continuing to see more surprises to the upside in G10 inflation data than surprises to the downside. So again, another instance, another more evidence to suggest that we are still, even this deep into this period of high inflation, we are still seeing both central bankers and economists underestimate the extent of this persistence in price pressures. Central bankers around the world have raised rates more aggressively than pretty much everyone anticipated. We still think that's likely to be the case in the next few meetings. As we'll get on to, we still think that at least a couple more hikes are on the cards for many of the major central banks, albeit our conviction in that call has certainly receded, given the uncertainty we're seeing in the banking sector. We're going to now focus on the fallout from the recent G3 central bank meetings of the Federal Reserve, ECB, and Bank of England, all of which have met in the last couple of weeks or so. And we're going to start by talking about the Federal Reserve. So I'm going to pass back over to Enrique. So Enrique is going to talk about the recent Fed meeting and its impact on the dollar.
Okay, thank you, Matthew. The outcome of the Federal Reserve meeting for March was very much in doubt up until the last second, because it was not clear what the fallout of the collapse of Silicon Valley Bank and another minor bank that collapsed in New York in the same weekend. It's not clear what it was going to be. In the end, it matched our expectations on the market by hiking rates 25 basis points. However, the communications were not very hawkish. In fact, overall, we think that it deserves to be called a dovish hike. Whereas it did say, obviously, that the U.S. banking system was somewhat resilient, which could not say otherwise. The dot plot of rate projections was also kept largely unchanged, but Chair Powell specifically mentioned and referred to the additional tightening that would likely come from the banking crisis. Regional U.S. banks that have to raise capital and then not have to worry about their equity position are probably likely to be somewhat less aggressive in extending credit to businesses and consumers going forward, and that is that means additional tightening of financial conditions, which conversely means that the Fed probably has to do less hiking than it would have done in the absence of the crisis. In response, the language was changed. It used to be that the previous meeting, it explicitly said that there would be further hikes. And this meeting, the wording was changed to some additional policy firming may be required, which means that whether or not it hikes at the next meeting or whether or not there are even more hikes is up in the air. And it will depend on, one, inflation, as always. If we continue to see inflation surprises to the upside in inflation, the Fed may have no choice. But two, we'll have to watch very carefully for the tightening of financial conditions and credit conditions that results from this tensions in U.S. banking. We think we're back roughly to where we were in early February. We still think that one more hike in 25 basis points in May is more likely than not, but anything after that will depend on inflation numbers of the next 2 months, and obviously the fallout from the banking crisis, which will take a few weeks to be felt in the economy. If inflation comes as the Fed expects, and the fallout from the banking crisis is contained, then we would expect the Federal Reserve to pause after that. And where we see a significant difference between our expectations and what the market's pricing in is we still see no cuts throughout the rest of the year, as we expect inflation to remain elevated and the fallout from this banking crisis to remain limited. We go to the next slide. Again, the key question is not so much whether we get one hike or two or zero, but when and how aggressively the Fed will cut rates. The future market is pricing around 4% by year end. This would be almost 100 basis points, a full 1% of cuts. Whereas large is this problem that the US banking sector seems to have of having lost money because of the increase in interest rates in their securities portfolio. Whereas we think that the Fed may have good reason to be cautious. We do not expect a let-up in inflation numbers. There's still no sign whatsoever of loosening, of significant loosening in the labor market, which will keep pressure on wages and prices. And we think that the aggressive intervention by the authorities and what we regard as the de facto guarantee of all deposits, at least temporarily by the federal authorities, means that the fallout from the credit crisis, there will be no credit crunch. At most, we will see some marginal tightening of credit conditions, and certainly nowhere near enough to warrant the massive, significant cuts that markets are pricing in. We go to the next slide. European Central Bank. I think that I will pass on to Matthew.
Thank you, Enrique. I'll take this one.
Sorry, Roman.
European Central Bank is clearly shifting to data dependence. It has been already saying that it will be data dependent prior to the most recent meeting. However, this has been really emphasized, and it's quite understandable given the context of the banking sector turmoil. So what we have seen in March has been a continuation of policy tightening. The policymakers at their previous meeting in February stated that they intend to hike by 50 basis points, and they indeed deliver on this promise, despite the uncertainty to what they're going to do. And we think that this was a wise move because on the one hand, the economic data warrants additional policy tightening. We are seeing elevated inflation, core inflation still probably did not achieve its record level. And also we are seeing very tight labor market, which is likely to produce some additional inflationary pressures as the wages appear to be increasing. But also, on the other hand, we are seeing that this move can be viewed as a signal of confidence in the banking sector. And during her speech, Lagarde also shared her views that the banking sector is strong and resilient. And also on some other occasions, she repeated that. Looking at the inflation projections, the ECB cut the headline inflation projections, which is understandable considering especially the sharp decline in energy prices and especially gas prices that we have witnessed, and that was mentioned earlier. But the core forecast for 2023 was upgraded, which confirms that the underlying pressures remain in place. Lagarde in February said that they are alive and kicking, and this indeed seems to be the case. So this new projection, even though the headline inflation is assumed to be lower, still confirms our views that the central bank will need to tighten policy further. The hike was perceived to be a dovish one, because the guidance on further hikes was removed. In February, the decision makers stated that they intend to hike by 50 in March. In March, we haven't seen anything alike. And what we saw was a even greater emphasis on data dependence. So what this emphasis means for the FX market is likely that, especially if the banking turmoil calms down, the market is likely going to focus on the macroeconomic data. One of the most important data releases ahead of us is this Friday's inflation report for the Eurozone. And it is likely that the market sensitivity to this data will be high, so it will likely determine to a certain extent the market pricing for the upcoming rate hike from the ECB, and also is likely to have an effect on the euro, especially if we see that the numbers diverge from expectations. We think that the current rate pricing, which was corrected because of this banking turmoil, is too low. Right now, the market is pricing about 30 basis points of rate increases before year end from the ECB, which implies 1 to 2 interest rate hikes. And we think that there is a room for the upside here. As you can see on the left-hand side, this is the corrected pricing. So some of the recent move has been corrected. However, it's still way lower than what was before the banking sector. So the deposit rate was estimated to end the year at about 4%, even slightly higher. And what we are looking at right now is the market expectations of about 3.3%. We think that this is too conservative because what we are seeing is still core inflation, which is breaking records. We are seeing that the economic data remains resilient. Recent PMI numbers have been very, very good, especially the service sector data. And what we are seeing is the strong jobs market, which can create additional inflationary pressures. And on the right-hand side, you can see the US-Germany 2-year yield spread. And as you can see, it has been rather volatile of late, but the trend since the summer has been towards a decrease in this spread. And this has been one of the reasons for our bullish euro-dollar call. We think that the tightening of the differentials in market rates will help the euro to continue marching upwards, and we expect this trend to continue. And right now I'll pass on to Matthew.
Thank you very much, Roman. I'm going to quickly go over the Bank of England announcement we had last week. I'm a little bit conscious of time, and I'd like a little bit of extra time for questions at the end. But the Bank of England, as expected, raised rates by another 25 basis points at its MPC meeting last Thursday. The announcement, unlike both the Fed and the ECB, was quite a hawkish one. The vote on rates was split 7-2. Markets had expected a 6-3 vote. The MPC no longer expects a technical recession this year, and this is something we've been saying for a number of months. And importantly, the line in the statement on additional hikes was maintained. The bank said that additional hikes would be required if inflation were to prove persistent. We think this is a clear signal that a hiking cycle is not done just yet. Indeed, we have not seen any sort of dovish tweak in the remarks that would indicate that perhaps maybe one more hike is on the way. So we still think that multiple hikes are in the offing from the Bank of England, and we're penciling in a couple more 25 basis point rate hikes. As I mentioned, data out of the UK economy has been very good. PMIs are back above 50. GDP data is largely surprised to the upside. Core inflation's surprised to the upside. And macroeconomic conditions, in our view, do justify at least a couple more hikes, while of course the UK banking system appears relatively isolated from the recent turmoil. So that, we think, could potentially be bullish for our sterling forecasts. And indeed, so far this year, the pound has been the best performer in the G10, partly due to this slightly more hawkish stance we're seeing from the Bank of England. As far as markets are concerned, we have seen a little bit of a retracement in market pricing for Bank of England rate hikes, although since the start of the turmoil, only around 50 basis points has been shaved off the market's expected end of 2023 rate for the Bank of England, which is much less aggressive than both in the US with the Fed and in Europe with the ECB. So again, partly the reason why we've seen sterling outperform since the beginning of the turmoil is that markets believe it will have less of an impact on Bank of England interest rates. And again, as we've been saying, in that time, UK data has continued to hold up rather well. We see both at least a couple more rate hikes from the Bank of England and very minimal risk of any Bank of England rate cuts anytime soon. So what's next for the FX markets? Well, as we were mentioning, we think that recent banking concerns have been slightly excessive, and that the failures that we have seen have been largely due to poor decision-making rather than any systemic issues within the banking sector. The extent to which it continues to impact markets will, of course, though, be highly dependent on the extent of additional panic among both depositors and market participants in the next few weeks. We think that panic has been excessive, as we said, but it remains to be seen how long this persists. And as far as central banks are concerned, as we were mentioning, we think that economic conditions, particularly the stubbornness of core inflation prints, warrants additional central bank rate hikes. That could, we think, lead to additional rallies in both the euro and sterling against the dollar, given that we see slightly more of a chance of US rate cuts this year than in both Europe and the UK, albeit our base case is still that interest rate cuts in general are unlikely anytime soon. We've gone over a little bit, unfortunately, the hour mark, but we will stay on, and we'll have a little bit of time for any questions that you might have. So as I mentioned, if you do have any questions that you would like to ask us, please feel free to pop it in the Q&A function in the Zoom app, and we'll try and answer those questions now.
Yeah, let me take this one. There's a question about the future evolution of Euribor. The important here is always to start from what the markets are pricing in, because the markets are generally do a pretty good job of projecting into the future, and one has to have a very good reason to disagree with them. Right now in the Eurozone, the overnight rate is expected to peak somewhere between 3.5 and 3, somewhere between 3.25 and 3.5%. The prospects for cuts priced in the market is very, very limited, unlike the US. So my personal view, and I'd like Matthew and Roman to share theirs because this is a very important question, is that we're going to see a peak of rates above 3.5%, and we're going to see it closer to 4% than to 3.5%. The reason for this, I think we went over it in the presentation, is core inflation excluding the volatile food and energy components, has yet to show any signs of peaking, let alone starting to come down in the Eurozone, and it's a completely unacceptable level. So my guess is that we're going to see Euribor peak closer to 4 than to 3.5%.
Yes, I would agree with that. And I think, as we've been stressing during this presentation, is that we think that repricing in rate expectations that we've talked about during this recent episode has been excessive and a little bit aggressive. There are two different issues. One is the banking sector turmoil. The other is economic conditions and sky-high inflation. And they have two different solutions. And the inflation outlook, particularly in the Eurozone, in our view at least, does warrant additional hikes from the ECB. And certainly, as I think Enrique certainly mentioned, as Roman mentioned as well, more room for the ECB to surprise to the upside in upcoming meetings relative to market expectations than to surprise to the downside.
The second question is also I'm sorry, Roman, I interrupted you. Go ahead.
Yeah, I think I would agree with that. I think that what we are looking at is at least 25 basis points hikes, or at least 50 basis points of tightening. But I could easily see rates topping out at about 4%. As you mentioned, we are not right now seeing any slowdown in core inflation. So I would focus on this number moving forward. but I think that those banking sector concerns are perhaps dying down a little bit. And if this will prove to be the case, then I think the market expectations will move towards our view, and this should support the euro dollar.
Okay, the next question is actually a good one. Sticky inflation figures imply that the issues are supply side as well as demand. Why are central banks therefore continue with interest rates? Is it because they have no other tools in the box? The quick answer is yes. That's pretty much the only tool in the box for a central bank. There is another tool, which would be fiscal discipline, either increases in taxes or reduction in government spending. But that seems to be politically off the table. So the only tool that we have to fight inflation is interest rates. I do think that will be more effective than it gets credit for, especially in the Eurozone. I mean, the purpose of interest rate hikes to control inflation is to reduce demand by taking money away, frankly, from households and corporations. And given that in the Eurozone, most debt is variable and linked to the overnight interest rate, I think that this is having this, it will operate with a lag, but it will have a definite impact. All the extra money that households and businesses have to pay in interest rates, in their mortgages, in their business loans every month is money that, unfortunately, to be blunt, they don't have to spend, and therefore reduces demand and therefore reduces inflationary pressures. That said, it would be far preferable if the fiscal side, the government spending and taxation side, was also helping to constrain demand, but politically that doesn't seem like it's going to happen. So we just have the one tool.
Yeah, but it also doesn't mean that the issue is only limited to the supply side. And as we could see from the core inflation, or generally looking at the energy situation, I think that there has been a lot less demand destruction recently. And what we have seen is that the wage demands in the Eurozone seems to be picking up. So I think that there is a significant component of demand inflation, and the risk that this component could be more pronounced. So I think that addressing it through rate increases is not something unreasonable in this context.
Great. We have another question on Credit Suisse as well. What was the main cause of the loss, and is it an issue with other banks in Europe and UK? Not something we see in Australia.
Let me take that. Credit Suisse, like I said, is probably the most creative bank in history in terms of finding ways to lose money. Frankly, many of those losses had little to do with the typical risk that one is concerned with in banking, such as credit risk or interest rate risk, had to do with fines for having insufficient compliance systems. It had to do with participation in dodgy deals in Africa, in Mozambique, in a variety of places. It had to do with operational shortcomings. It was a variety of problems that are largely unrelated to what brought down Silicon Valley Bank, that are largely idiosyncratic. No other bank had a similar suite of problems in Europe, and brought it to declare a loss of 8 billion euros, Swiss francs, sorry, this year, which basically wiped out its entire profit for the last 10 years. But again, it is not your typical banking losses that are related to credit defaults or interest rates. It was a variety of operational and compliance issues.
Excellent. I don't know if anyone else has any more questions. If you'd like to pop any more questions in the Q&A function. If not, I think we can perhaps wrap things up there. I don't know if you have any final thoughts or comments, Enrique or Roman.
No, I think that In summary, we think that the banking crisis, which is what's in everybody's mind nowadays, will have some effect, tightening credit conditions in the US, much less in, if any, in Europe, the UK, and elsewhere, really. So we may see the end of Fed hikes soon, at least for now, but I don't think that's going to be the case in the Eurozone or in the UK. That would be the main takeaway.
Excellent. I think that's a good point to end the webinar. So yeah, so thank you all very much for joining again, and yeah, be sure to look out for our next webinar in a few months' time. So thank you all very much.
Thank you all. Bye-bye.
Thank you.